Our guest today is an investor from a family office, Navyug Global Ventures, with a group AUM of more than 3,500 crores.
If a founder does not understand the balance sheet, he may not be able to understand the business.
Top three biggest mistakes that you see these founders making in these meetings.
Is when a founder saying that I'm really having a fantastic market, I keep investing myself all the money into a marketing, but I couldn't have the money to pay the GST. Well, it's the biggest red flag for us. You are only 3 months, 6 months, and you're asking just because you are in the same industry, you're asking the same multiples. What way this logic applies?
For a founder who is raising today their early stage, so how much a founder needs to dilute at each stage of fundraising?
We shouldn't dilute more than 5%. At this level, he should be still holding 50 to 55% with them.
In the anticipation, it might actually kill your startup to just. Hi, and welcome back to another episode of Pivot Point with Usha, where we talk to founders and investors actively writing checks. Our today's guest is an investor from a family office, Navyug Global Ventures, with a group AUM of more than 3,500 crore. It has invested in more than 20 early stage startups within a time span of just 2 years. Please welcome Devanand Subramanian. He has scaled 500 crore plus brands and has been a part of startup ecosystem for more than 3 decades now.
Thank you, madam. Thank you for having me here. And I've been watching your shows. I've seen like so many luminaries coming to the show and really giving a lot of informations to the startup and also the ecosystem. So I really feel grateful to be part of this show.
Thank you so much for your kind words, sir. So to start with, I would love to know how your journey has been to becoming an investor. Were you also building initially? Because right now you're helping so many founders. So how does that journey has become?
Like I actually represent a family office in the name of Navyug Global Ventures. So the once like the founder of Navyug Global, he expressed his intention to start an investments to various startups. So that's where like we started the journey with talking to various startups, connecting with ecosystems, primarily from Tamil Nadu as an angle. So that's how it started. But like slowly, when we went on continuously meeting at people, two, three things really struck me. One, like I could see a lot of enthusiasm among the people, and today's environment is like everybody would love to start an startup, irrespective of what background they come from or where they educated. And the second aspect which I could see is the people coming from an rural has got a lot of ideas which is pertaining to the scalability among the rural environment, and it really addresses that pain point. Then normally when we see in some of the urban-based startups, like whether it's in quick deliveries or sorting out certain issues and other things, whereas the rural, like I really see a lot of real pain point unaddressed over the longer years, and they coming out with some solutions which can be scaled in those years. That really struck me very nice. The third thing is that like I could also see I come from an almost 35 years of operating various businesses across industries, whether it's in IT or education or appliances, distribution, or into an after-sale service. So when I coming from the scaling up those businesses and operating those businesses, now what I could see in present environment is like people just really talk about the valuation, and before the valuation, before the scaling up, something they don't understand is that when to value something and when to scale.
Yeah.
So these are some things which, but the journey for the last 3 years has been completely inspiring. I would say that because most of the time when I meet startups, like I really feel something like why it not struck me, like how this idea has come from, and like just a lot of inspirations keep happening day on day.
Yeah, yeah, absolutely. I mean, it must be amazing to talk to so many founders and the crazy ideas that they're building, that they can
And
see, the identify the problems.
to connecting with an younger audience is also very energetic, like people coming from across 20, 25 and beaming with ideas really
Yeah,
make you more active practically and more energetic.
absolutely. And um, I would love to know some of the crazy ideas that you felt like, is anyone thinking about it and these people are already building in this area?
Uh, yeah, a lot of ideas but a few of them which struck me really is that see, I always feel certain. I always believe in one thing. Like I always call it as a bottleneck. When you see something as every industry, every business, every institution will have a bottleneck. The only point is that they'll have to analyze whether this bottleneck is pertaining to the internal bottleneck or it's an universal. Now, when
Yeah,
you really identify that and when they see is an universal, then if they can build up on a business around it, then that becomes a real startup. Okay, a
yeah.
startup idea and other things. Like I was recently talking to one person, he was talking about predictive deliveries to the end customers. Like we always
Okay.
see what we want, we order from quick commerce.
Yeah,
Now he was talking about like analyzing the buying patterns of the customer based on that, like sending the extra goods on a predictive way so that like ASP gets increased. I really thought like what is this? Like how and like a lot of questions came up like how you will monitor this and for every question he had a fantastic idea behind it. A complete tech driven uh,
yeah.
connected with AI and also one connected with the distribution. I said, wow, like there's something new which is talking about. So like this, so many ideas which keeps people keeps talking about it.
Great. And so, what's your current thesis and where are you investing right now?
See, we as a family office, we had different lines of business. We were in NBFC, we were into insurance broking, we were into distributions. So initially, when we thought of investing into startups, we purely looked it as an creating a funnel to our existing line of business or sorting out some of the concerns or issues which we wanted to address. That's why we thought of investing into a startup.
Yeah,
Slowly and steadily. So initial days we were focused on clean mobility. We were focusing on mobility areas. We were focusing on a distribution patterns. But slowly and steadily, when our funnel kept on growing, we also started investing into deep techs. We the one thing which we always bring in as a family office is that we are not like we don't constrain ourselves with a specific of 3 years or 4 years or 5 years being with a startup and seeing our valuation out. Because we are not coming from an so-called third-party investments or a VC mindset. We come from a family office. Being in family office, like it's an two generations and 3 to 4 decades of business backgrounds. So we truly understand like the ups and downs happening to the business, and we truly understand the patient capital and how and over a period of time that patient capital can become an exponential. So with those lens, we view all the businesses, and so we were also comfortable to invest into a deep techs based on this because always people say a deep tech comes with a lot of the incubation time to really explode. And it suits our theory. So we also moved from apart from investing into mobility, green, climate products, we also moved into them deep tech also.
understood. So, if a deep tech or climate tech startup were to reach you, what is the size of investment that they can expect?
We purely focus on early stage revenue companies at a level of fund early stage investment cycle only. Like we help them in supporting their MVP or we help them in supporting the scaling up. So
Okay.
our investment anywhere ranges between 50 lakhs to 2 CR per ticket size per company. And subsequently, like once we keep investing into them, then we keep investing with them over a period of years whenever they have an additional rounds also, so that we don't exit. We keep ourselves invested into them.
Understood. And as family office, do you have like certain funds kept aside for this year to be deployed? Something
Yeah,
like that?
like every year, like we have an prescribed amount how much we invest into a startup. Like over the years, it was slightly growing up also. First year
Mhm.
we had an set aside 10 CR. Second year we made it as 25 CR. And this year we are already we are set aside as a 50 CR to invest. And believe me, we are
Interesting.
in just about 5 months of if when talking about a financial year, we are just about
Yeah.
2 months away. But already 80% of our investment has been already blocked. Like
Wow. Okay.
so they are all in the various stages of due diligence and other things. But the initial commitment has been already given.
Okay. Understood. Great. So when these companies come to you, what do you see in the founder before selecting them further?
See, the first thing we really see with the founder is he completely committed to this project? Uh, we don't believe in somebody keeping an offhand to this and uh, continuing with this existing employment, also trying something. Now, if at all he is not fully convinced in what he is doing, how can I be convinced with what he is doing? That's the primary
Correct.
theory.
Yeah.
So we completely looking for his conviction, first thing, and second thing is
Mhm.
his complete knowledge about what he is doing or what he is developing.
Yeah.
We are not expecting an startup founder to be expert in everything, but a
Mhm.
startup founder has to be a complete knowledge expert in the product, what he is developing. He might lack in marketing, he might lack in finance, he might lack in distribution. All those things is understandable. That's where we can also would like to add a value addition to it. But at least he should be a complete knowledge based, knowledge driven, and having a good understanding about what he is developing. That's the second thing which we're looking for.
Yeah.
The third thing is we also looking for a team what it's comprising of,
Mhm.
because the one man company somehow we feel that it has its own ups and downs. Though the
Yeah.
prime idea can be an one person, but if he
Mhm.
doesn't have a small core team who are all
Mhm.
aligned with this thinking, then it becomes sometimes it becomes very difficult to scalability. And there has to be a certain internal board system also to be there to question each and every idea what is trying to do. Otherwise,
Yeah.
uh, sometimes people get overdriven with their vision and uh, and it defeats the logic. So if there is an internal questioning, so we see this whether the founding team has at least have an, if not by means of founder, at least if there
Yeah.
isn't 2 3 people who are core into the business and where the decisions are completely discussed before implementation. So internal core system which we always looking for. And the
Yeah.
fourth thing is we also see that how much it is scalable. Now, before scalable, we really see to that whether whatever is developing, is he able to implement those things in a smaller geography and see to that it is working and the customer is accepting it and is the revenue keeps coming up and whether he is able to address to the needs and the demands of that particular territory. Then only
Yeah.
we drive him to expand it. Now,
Mhm.
just because somebody has cracked with the concept, we don't want him to be scalable before trying into a shorter geography or a shorter acceptance. So this is some things which we primarily look into a startup before we really invest into them.
Understood. So do you also look for, because they are at initial stage, do you also look for some kind of traction or what customers have
That's what
been
I say.
telling about it?
That's what I say that like we really looking for attraction. Probably I may not have used the word attraction, but we want him to apply his product or sell the product in a certain smaller geography and see that
Mm.
people are accepting it and he's able to address to the demand. Because uh, if the product is not addressed within a shorter geography and if the demands are not met and if the
Yeah,
customer is not addressed timely, see here like the India is a complete value-driven market. Now, like, looking at an international level and implementing those international policies in India is
yeah,
difficult.
mm.
Indian customers don't comment directly, but they walk away without notice. So that is
Yeah,
very important. So if we are not addressing a customer demands and if you are not being able to give them a value, we might have been able to have a big viral thing. Like one day we can see 10,000 people sending a demands to us. But after 30 days, we would be seeing that not even 5 people or 10 people are repeating buying. We would
yeah,
actually will have to wonder like what happened to those right? That happens here because people don't give comments, they just walk away. So we
yeah,
really want him to first have a implementation in a smaller market, see the traction, uh, get to enter the complete cycle of it, then expand
yeah.
it.
Understood. And so I know how many, like, you'll be talking to so many founders before they actually get to the point where they are finally shortlisted and like you guys are making the deal. What is like top three biggest mistakes that you see these founders making in these meetings?
The biggest deal maker we always see is in compliances. So the most of the time the founders comes, they have a fantastic pitch. We really see the numbers sensible also. We really think like, okay, we should be in a position to invest. Then when we look into a basic KYCs, we really see that the KYCs are not proper. His GST filings are not clear. His MCA filings are not clear. There's so many red flags happening in the compliances. The moment there is an, if I remember a place when a founder said that uh, I'm really having a fantastic market. I keep investing myself all the money into a marketing, but I couldn't have the money to pay the GST. Well, it's the biggest red flag for us because if you're not compliant,
Yeah,
whether you do marketing further or not, at least you should be in the first fulfilling your requirements of important requirements. Then you spend the money to a marketing. Without fulfilling the requirements, it is difficult. So the first thing which we always see is the compliances. And the second thing is we also see the financial ability or financial understanding of the founder. So I sincerely feel that if the one question I try to ask at the time of finalizing a term sheet with the founder is that I ask
yeah,
him, do you understand balance sheet? Do you understand the elements? Do you understand the PE ratio? Do you understand EPS? Do you understand the asset liability and those things? Because if a founder does not understand the balance sheet, he may not be able to understand the business.
yeah,
So this is something which we ensure that like basic, he is able to explain me the balance sheet and why those points and why those numbers. Because at every level of pitching, whether it's
yeah,
a venture, debt, equity, he may have to explain about all the questions are going to come only based on the papers, right? The only papers from where somebody can ask a financial questions is from a balance sheet only. So if he
yeah,
is not able to address to that point, he may not be able to have a scale up. Why to think about in future? Why not at that particular point of time? So
yeah,
investing
certainly.
in them might take 3 months delay, but that's not a problem. Let him understand it. The
Mm.
third thing which we always see is the founders are very much hurry in taking an investment, but he does not have a plan post investment how he is going to go for a round two or a scaling. That also we
Yeah,
have started seeing. The fourth thing is before coming to the stage of valuation, before coming to a stage of term sheet, it becomes really hard for us to convince somebody on a valuation. He always says that this industry, this is the multiples. I said, at what
Mhm.
stage? If you're referring to a company, why you're not saying that a company has been invested in 10 years, 15 years running, and you are only 3 months, 6 months, and you're asking, just because you are in the same industry, you're asking the same multiples. What way this logic applies? So this is
Yeah,
something which we really see in the startups.
absolutely. So coming to the valuation, which is one of the biggest question in founders' mind, and one of the points which creates difference in opinion. So what is the right way to value their startups?
See, I will not go into a technical valuation of whether it is a DCF method or a market multiplier or cost to duplicate. I will not go into that. So that that valuers will explain them, or their auditors will explain them. So I will purely go into one stage, that what stage they are in and what is that they wanted to do in that particular place. Rather than looking into one asking for an valuation for a 3-year runway, why don't they ask for an valuation for a 1-year runway at the stage they are in under 1-year runway, and complete that, then go in for a higher valuation? Because today, for a company which is going to be, let's say, like a early stage startup doing about an MRR of about, let's say, 30 lakhs, he says that he's going to do a ARR of 3.6 CR, and he's going to ask a valuation of about sometimes 20 CR, sometimes 80 CR also. The question is, this MRR would have been the highest revenue of any one best performing month. Okay.
Yeah,
Now, how do I say that that best performing month will duplicate in the subsequent months?
right.
And based on that, how do I say that it is an ARR? It's a projected ARR. How can I say that? I will always look into what was the past performance for the last 1 year. Then I will be able to track the ups and downs of the demand in those various months of that year. And I will be always plotting the future growth also based on that only. Probably I will be taking in some more inputs with regard to the increase in geography or increase in the market size. But I'll surely only consider the which are the best months and which are the lower months. Okay. So
Yeah,
based on that, again, somebody is asking for multiples. Sometimes he just simply asks for multiples, and sometimes he asks for like multiples based on the similar industry expectation. Then I always tell them that, boss, like you rather than like you ask for an if you are in 30 lakhs MRR company, and you ask for an 60 CR valuation for whatever reason, and you are ready to dilute a bigger amount. Whereas from an early stage investment to a stage of a listing or to a stage of an, getting merged, it is at least a minimum of 8 to 10 times of a different stages of a investment cycle. And if at all after the end of the period, just one second, all right, no, 2 o'clock. So after the end of the complete cycle, if at all, if they don't even have an 15 to 20% with them, what is the use of spending about 8 years in putting in time, energy, heart, soul, in sacrificing the all the family commitments in building something, right?
yeah,
So it is
absolutely.
important not to dilute a bigger level. The most of the time, I see a startups losing up to 20 to 25 percentage in a very early stage of investments,
Yeah,
just for a one simple reason that they are able to have a better valuation. They are able to demand a better valuation. But once you are lost 25 percentage at the stage one, what is that you will have it in the stage eight? Or will the stage three, investors will be still interested in you? That becomes a question. So
yeah,
our valuation theory will all fall into this kind of an angle. Like we really see that what stage he is in, how much money is really needed for running next to 1 year.
Mm.
So based on that, only that money asks, and that to that extent of a multiples, we really look at his valuation. If he's not able to understand the sense, we say yeah, goodbye, no issues. And we are not saying that others will not invest, but it doesn't suit us, our investment pattern.
Understood. So you also talked about dilution and how much, initially they should not be diluting so much because they have like a lot of subsequent round and they need to save it. So for a founder who is raising today their early stage and then they have other rounds also planned after this, the business is such. So how much a founder needs to dilute at each stage of fundraising? What do you suggest?
You know, I'll just give an indicative percentages. I may not be able to really it just like kind of a ballpark figure. Considering
Yeah.
that after all this dilutions also, he's at least holding about 10% plus when it's something a big thing happens, kind of an IPO or an exit. Okay. That way, like in an initial days, like I divide this investment pattern into multiple angles, and all my discussions, my viewpoints purely comes from one stage, often early stage investment only. I will not be in any kind of an putting my views into an advanced stage of investments. Okay. So
Yeah.
if somebody is coming or somebody is having a idea and he starts taking your money from his year and years, probably we shouldn't dilute more than 5%. And that is where most of the startups fail because that point of time they dilute 20% or plus. The second
Yeah.
stage, probably if he's going into any kind of a incubation centers, right? Incubation centers, you shouldn't dilute more than 3%. Then when he is going for a pre-seed round, which could be from an angel investors or
Mhm.
HNIs, that point of time, you should not divert more than 10%. Then when he is going to go in for an distribution angle, the next two rounds, put
Mhm.
together, he should not be in a position to dilute more than 10 to 15%.
Got
When
it.
he is talking about a scalability, which could be a pre-CDS or it could be a Series A, those segment, he shouldn't the dilute more than about 10%. So
Yeah.
at this still a level of Series A, where at least 3 to 4 rounds would have got completed in most of the cases. It's very rare, like within stage two or stage three, somebody reaches the Series A. Okay.
Yeah.
Now, at this level, he would have already shelled out close to 40 to 50% of the stage. Yeah, from then on, like it is the bigger VCs will come into play and they will help people to guide him to how much to dilute at each levels.
Mhm.
So till this level, he should be still holding 50 to 55% with them. And he should not look at because another 5% he will anyway allocate to ESOP.
Yeah.
So the dilutable will be only 50% plus. And I'm
Understood.
only talking to this, whatever I'm communicating will be only talking to somebody who is a first time founder. If somebody is already exited a first time business and getting into a second new business or third new business, this
Yeah.
formula doesn't apply to them. I'm only talking to a masses where it's going to be a first time founders and how they are going to look at it.
Understood. That actually gives us a lot of clarity on first-time founders because they keep asking how much should we dilute? Is this fine? Is this not? Is it too much? Is it too less? So that really
Because like
explains.
anybody who is coming into any greedy investor who is coming into an angel investment or HNI kind of a first time investments, they'll surely
Yeah.
ask for a pound. But that is the grit what
Yeah.
founder has to keep maintaining, saying that not to dilute beyond a level.
Absolutely. So talking about different type of investors, right now there are, I mean, be it family offices, different level of angel rounds, and there are a lot of investors that are there in the market, and a lot of times it gets confusing for the founders on where they should be reaching out in order to find that right investor. What they should be, what a founder needs to look in the investor before they consider taking funds from.
Yeah, like your question was bang on. So I just remember a scenario in 2014 when I was running a company. I was like because of a lot of news available at that particular point of time. Like Sequoia Capital reached out to me, and I went and pitched against Sequoia Capital. But
Mm.
I did not realize that it was a pre-timed to reach and secure capital. I did not had neither the numbers nor the scalability to reach it to them. Probably that point of time I should have only reached to an angel guys or an incubation to be precise. So
Yeah.
this happens most of the time. So the like if you like as I said, like if somebody is just having an idea where no third party will be able to believe in him and believe in his concept, he has got nothing, just an framework in an Excel or a PPT or a concept diagram, which is in his mind. Then that point of time, he should only look in for his family friends who just believes in him and is ready to put in the money, who may not really understand the valuation and who just thinking that okay मैंने लोन दिया समझ लो या तुमको हेल्प किया समझ लो लाइक ओके ये पैसा रखे तो आगे बढ़ो तो आगे अच्छा रहेगा तो मेरे लिए खुश है that kind of segment. Now once he is able to really develop something, then at that point of time he should be in a position to go and reach to incubators or accelerators, the fastest incubators. So with this incubators, he will be able to access to the various grants of the startup. So which will help him leverage to develop the product, come out with an MVP, to do a market set and other things. Then he should be in a position to reach to an accelerator. Now, with this level itself, like he gets connected to various investment ecosystems over there. And if it's in a right incubation and accelerator, then further investments, you need not worry because all the startup ecosystem people are sitting in those locations and they keep getting in various demo days so where they go and understand which are the startups and what. And it automatically, the product is right. You will have an investor, identified investor, then enter it. So the
Okay.
next stage comes into one like kind of an angel investor or an HMAs or even AFs. So the AIF also comes in over there. That wherein like they put in a smaller money, like kind of anywhere between 25 lakhs to 50 lakhs or 1 CR kind of investment. See that like is able to scale this up by means of a distribution to an angle. The numbers starts flowing in, then he should be in a position to reach to one kind of at a kind of a very serious level or seed. You should be in a position to reach to some of the VCs. Again, in VCs, there are you should be able to do a lot of research today with all the AI. You really can easily understand who is a early stage VC, who is a mid stage VC, and who is an advanced stage VC, who is a pre
Yeah.
IPO stage VC or which funds are into. Even when I say a family office, the family office is also divided into so many things. There are few family offices which purely invest in early stage like us. There are few family offices who only invest in the pre-IPO stages. So
Yeah.
you'll have to do really see a complete research and to understand that what stage he is in and who he should be able to reach to, then only foreign things will happen. Otherwise, just sending in random emails, random networking, and random meeting calls, speech calls. As I said, we will not be able to tell them that why we are not saying no. Yeah, no means probably it's not a permanent no. Then no sometimes also means that at this stage we are no. Probably we can consider in the future stage. but
Yeah.
he will only think it's a no. We at our stage also we may not explain why it is a no now. That gap
Mm.
always happens.
So when you said, and I feel this, a lot of founders do when they receive rejection or they get no, they take it to their heart, of course, because it's their baby they are building. Uh, but I also hear from you that it's just a no right now, right? So what are some things that they need to still be doing? Maybe share updates with you to still be in the consideration.
I see like probably like few of the startups I keep seeing is that like probably we would have said no 2 years before, but I keep getting updates by an email or a WhatsApp from them whenever there is a new growth happening. And it has
Mm.
happened in a case that like I have we have said no to a startup, uh, and every 2 months once they were just sending us an updates with what is happening to them. And after 3 4 months of updates, that one day again they try to reach, can we pitch it again? So he said, fine. Now, within 10 minutes after pitching, we said, yes, we are interested. So
Mm.
now it is just not bombarding with so many things. To take a care, not to intrude, keep sending in updates, like whichever, like after one or two messages, you will understand that the other guy is responding or reading to what kind of thing, whether he's email friendly or he's an uh, WhatsApp friendly or is a Telegram
Mm.
friendly or is a Instagram friendly or is a LinkedIn friendly. So
Yeah,
keep tagging him, keep sending him. So let him see some of these messages, let him get some update so that like he is in a right, he also sees the growth, he has updates. So when you again pitch it to him, then that's a lot of sense which happens over there. Okay, the first opinion, what you would have
yeah,
happened or may not be the thing. Most of the time,
absolutely.
it is just not the product would have been an excellent, but the communication would have been a pure. And when I
Mm.
say a communication is poor, it is not. I'm not talking about the language or a sophistication of a language. Just communicating the value. Now, like suppose if any founder just thinks for a moment, most of the people would have come from a family of doing a business. Okay. Now, if you just make yourself to sit in an other side table, and if you just see like what is happening, or I would give a very another example. If I'm a startup, okay, I would always would love to do one thing. First, I will go and reach to the bankers.
Yeah.
Okay, when I meet 5 6 bankers, when I talk to a 5 6 credit analyst, they will be asking the type of questions which I'm able to understand those questions. And when I'm going to
Mm.
be prepared with those questions, answers for those questions with the
Mm.
founder or with the investor, sorry, then
Mm.
probably I'm a 50% walkthrough. Because most of
Yeah.
the time, the credit analyst and the investor is not two different characteristics. Probably the investor comes with a higher level of risk, credit analyst comes with a lower
Lower
level of
level.
risk. That's the only difference is there. They purely look at an collateral security. Investor look into a downside protection. So only the two things. So
Yeah.
once you are able to talk to a because most of the time credit analyst says on the face. If you go to a bank, if you go to a NBFC, if you say sometimes you get an replies on the face. They say that this reasons, or at least they send you an email saying that because of these reasons, we are not in a position to fund you right now. So
Yeah.
get that grill. Probably you might say that, okay, this is not going to happen. No problem. Get that grill so that you are able to face the investor in a better way.
Yeah. So, a couple of things like when a founder comes to you and they start pitching, what are few things that needs to be on top of their mind? be it few numbers that they should just know and few things that really impresses an investor.
Yeah, exactly. I was going through a pitch of somebody. Now he was explaining the 3 years growth, 5 years growth. Then I asked him to send an Excel sheet. He sent me. Then I asked him on to e-meeting with him. I went to the Excel sheet. I started asking questions from the certain numbers based on that Excel sheet. Okay. There are two scenarios I'll see. One guy said that he'll have to come back. He'll have to ask finance team. He'll have to. It was not prepared by me. It was prepared by auditor. I just gave him
Yeah,
a number. So I don't know why this number came up. So it was a kind of a big red flag for me because you are presenting a data and you don't know why this data is there. Now, in
yeah,
another case, uh, somebody pitched me and I could not actually see a very big upscale in that business. It was kind of a more of a your traditional kind of a business. But when I went down to a various the same exercise when I went down to it, he was able to explain me every number in that Excel. It was just running for about number of like at least 40 columns and then about 100 rows. And there was so much projections for next 5 years. Why investment at this stage? Why say expenses at this stage? What was interest calculated and how it was returns? He was just able to explain all those numbers. Then that point of time, I decided that irrespective of the scalability of the business or how attractive it is, I'm going to stay invested in this guy because he's clear what he's doing. So this is
yeah,
one thing which, because that's what at first I say that when we see in a founder, we see his commitment to that business. One. And if he's saying something, how much he's clear about it. Third, how much he understands the balance sheet. How much, to what extent he owns the numbers in what he's presenting. And most of the time, people say that like when they ask for like certain ask at certain valuation, you ask a diversification of the ask, they will just keep saying that okay, 30% allocated to this, 20% allocated to this, 10% allocated. You deep dive into that, you will understand
yeah,
that he doesn't have any numbers supporting it. Just is that like some consultant gave him a numbers, he just put it over there. It's again and
yeah,
something which is so the difference is when you address to a traditional family office, the problem, because problem what you'll face is because these guys have run the businesses, there is something like having owned and run the business, there's something that purely seeing their numbers and its multiplications and everything. If you talk to
yeah,
somebody who have run and owned the business, then so you can just analyze within 5 minutes that what he's trying to
mm,
do, how much is the actual thing, and how much is
yeah.
all cooked up. So that happens.
So another question is whenever these meetings are happening, and of course, as founders, we are always thinking what's going in the investor's mind, right? Uh, so when you are doing any of these deals, what are you like? How are you thinking about exits, or what are your thinkings like?
Uh, uh, I was addressing to one startup ecosystem. That time I just told them one thing. If I'm investing to take my money back, at least if I'm not investing through an AIF for somebody or VC, because like that, the responsibility of multiples goes to an AIF. But if I'm going to invest directly, the
Yeah,
one thing which I look into it is I know that my it is going to take minimum of 5 to 8 years for my money to get realized. One.
yeah,
In that case, if I'm not going to get a minimum of 30% IRR per year for that waiting period, what is the use for me to invest in a business? Probably I would have better invested into other instruments also. Because at least other instruments, irrespective of IRR, gives me a downside protection. Here,
yeah,
I'm not. Though you evaluate everything, at the end of the day, It is your luck and Bhagavan ka kripa to get your money back. All the senses mostly will fail because there is
Mm.
always a something which is beyond your control, right?
Yes, absolutely.
So that way, at least I would look at an a 30% IRR per year for an 8 years, whether he's able to give me that kind of a multiplication, then only I will invest. Otherwise, so this is something which, as an investor, I will always look in whether am I sure to get that kind of a multiplication over a period,
Yeah,
whether that business is really making sense to that extent. Given all kind of an this one like just not going. What is the worst? Even if there's a worst case scenario,
yeah,
still whether I'll be able to get an 15% IRR or 18% IRR at the end of the time. Otherwise, I won't invest. That is something which, from an investment perspective, I'll be looking
yeah.
at.
Understood. So, talking about your investments, has there been an investment which has given you the max return and you are like really proud of that decision today?
So, frankly speaking, like we are just about 2 years into this investment, I think, as a family office. So only last,
Mm.
this is our third financial year we have just entered into it. So we have not received any kind of an exit. But what
Mm.
we have seen is at least about 60% of our investment guys have gone into a subsequent rounds of investments. The few are in second round, few are in the third round, and few are in the fourth round. And we
Yeah,
could see that when I look into one subsequent rounds of investment, the valuation with what they have received it, I'm sure that I have made a good money with whatever I did. I've
absolutely.
not realized it's in the paper, it's in Excel. It might take a time to realize it, but at least like we have that feel of satisfaction that okay, at least 60-70% of our calls were right, and
Yeah.
we were in a position to gauge correctly. Yes.
Yes, and with good deals, there also comes a few deals that we are not really proud of. But are there any cases where you thought
Yeah,
this as a
I said
really good
sixty
deal?
percentage. I was consent, so there was always another 40% where I was not comfortable.
Okay. So, have you also seen like these cases where everything was really good initially, but later on things went down the hill?
It happened in one of the case where like first 3 years, like it was completely a gala. Every once in a quarter meetings, the numbers were astonishing, and the guy was really growing
Yeah.
fantastically superb. And it happened such a way that a month before we filed a police complaint because the guy was absconding.
Oh, okay.
We
Yeah.
really don't know like when something will become rot, why it became rot, because at least like 8 to 10 quarters we couldn't gauge it. The numbers were
Yeah.
just happening all along. And not only just word numbers, the papers were right, balance sheets were right, all things were right, but still it didn't happen.
Got it. So, you actually talk to founders from all over India and I'm sure like even overseas. But so, do you see any difference in traits of really good founder? As you said, like you mentioned tier two, tier three, but any specific areas from where all these, I would say, gold standard founders with great ideas are coming up?
Like, okay, see, I've been actively speaking to one Southern India based founders and very less on a pan India level.
Hmm.
Now, there is no such standards that this founders are fantastic and the area founders are not so good. Not the probably like a founder of an Bangalore or Hyderabad has got a more connections and his outlook is becomes more bright and he has got more stuff understanding about how this entire ecosystem works. Whereas the guy
Yeah.
from an other locations of tier two, tier three is not that he doesn't have that kind of a connection. That's where some of the like if you look at from an TN as a perspective, like TN Startup, which is a government entity, which has really worked very well across the inroads. Like they were having an at least about they are having at least about 15 plus districts. They have gotten their own centers, and which they keep updating a lot of information, giving a lot of support, guidance to startups, and really building a good big network in those ecosystems. And also, like we are the part of Tamil Shark Tank kind of a stuff in the name of Startup Singham. And
Yeah.
that also, like we could see that this has come out as a very well as an GEC also, not purely as a serious investment platform, wherein the intention of making a startup discussion common at a dining table has been made. Because most of the
Mm.
time, for a startup founder, the biggest obstacle is not outside, it's your family. You have been doing so bright, so good. Why? What made you to leave all those things? Come and start up thing. You're not at all
Yeah.
earning, and so those things like I think this program called Startup Singham is being able to communicate to the people, like what IPL did it to the parents to support the children to pursue cricket as a profession. I
Yeah.
feel this platforms really makes parents to understand the startup journey and the valuation. Sometimes we get a call saying that you have invested so much, why you could not have invested furthermore without the funds of the parents, like, or even on an Insta things we get saying that like we would have been happy that if you have invested this much, but sometimes this also makes people that investment looks so easier, but one thing they forget is somebody to come to a stage where they get telecast in the show, which means that there were only few people out of 2000 people got
Mm.
selected, and there were only the few people who have crossed minimum 6 stages of various selection processes and got narrowed down into this. Because like
Yeah.
what outside world sees that like they just came on the show, within 5 minutes people invested in them and they got the money. No, it is not that way. Probably there was a
Yeah.
6 months drill to come to the show, and
Mm.
before that they would have at least pitched it 4 to 5 times to same investors, and they would have at least spoke about so many numbers, so many validations, disapprovals, reworking, then they would have come to the show. So that back
Yeah.
end pain, nobody understands. It looks like a
Absolutely.
cakewalk.
Yeah, yeah. People don't know what's happening and the backstage. And I absolutely love such platforms which creates awareness for, as you said, like parents and people who do not understand that it is also a career choice. This is also a choice that we make to build and not to just work under someone, right? So those struggles are very real, be it in Tamil Nadu, in Punjab, in Haryana, anywhere. Like
Anyway.
we all face it. That's true. And so one more thing that we were talking about, and I really want to know when a founder has raised their first round and when they go for subsequent rounds, what are the challenges that they face?
uh, for most of the founders, what happens is after raise the first round, they get a first biggest validation, and most of
Yeah.
the time their time get distracted with the various networking events. They become called
Yeah.
for to speak onto a various speaking elements and other things. And you not believe after somebody securing a consent or commitment of a first round, 40% of the people have failed to complete a due diligence for just one reason, saying that they say that like no, we don't find a time. Now something is intriguing to me is that what is that from a word of just a commitment is going to have an effect on them without they really realizing their money coming into the bank
Yeah.
account. And that is the most important stage, not getting a commitment. The commitment हवा में रहेगा तो तब तक पैसा बैंक अकाउंट के अंदर नहीं आएगा. Now I used to sometimes like in my business days, when I
Hmm.
receive a bigger check from a client, I will always tell my team, पहले जो check तो pass होने दीजिए फिर बाद में देखेंगे. तब तक तो it's not to call it as a party. So that
Yeah.
so unless until it doesn't hit your account, it doesn't make any sense. Now,
Yeah.
this one scenario which I could see it. The second scenario, what I also see is that the most of the founders are not prepared to understand the actual time period of getting that money into their account. Let's say like today I'm signing a term sheet with a founder of so much amount at such an X valuation. But after signing a term sheet also, it's going to really take anywhere between 3 to 6 months for the money to actually flow in. Because
Yeah.
before finding a term sheet, one FDD, LDD is something. After the finding a term sheet, it goes into micro FDD, LDD. And most of the time, you actually get a real data only after you file the term sheet. Until that, like you don't have access to the person's systems. So
Yeah.
once I signed the term sheet, then I have access to the founding company's systems. That is where actually I will get to know the data. So after that, it has to pass MDD and LDT. After that, it has to pass all the minor things. So it actually takes 3 to 6 months for
Yeah.
him to really realize the money. And most of the companies don't have that runway. They think that the moment the money was committed, they're going to have it. So that whatever the commitments they make it for the next first financial year, second financial year, from the time of getting the money, that doesn't happen on the time, and our commitments fails. So that the second round becomes a delayed, or sometimes it becomes a down round because the numbers are not fulfilled. I have seen
Yeah.
few of the startups whose numbers have come down after getting a commitment before getting a money because it was not a timely deployment of funds. The timely
Yeah.
funds will, if somebody is not getting a timely funds, it is a bigger lethal than not having the funds at all. You expect the funds to happen. You believe
Yeah.
a commitment was given. And if you're not getting a timely fund, it is more lethal than somebody being a bootstrapped without expecting any funds. Because until he is bootstrapped without expecting any funds, he would have at least tried 10, 20 methods to look in for various kinds of other debts and other money to come in to keep up running. Here he will be
Yeah.
keeping sitting with an expectation of money coming in, but that doesn't will not happen at that time. So that is one of the biggest struggle. The third thing
Yeah.
is the investors present founders, I see most of them, are averse to other debt funds, bank loans, NBFC loans, venture debts. Now, without these elements, going to a round two is going to be difficult because the round one money is most of the time invested for an product development or for a manufacturing purpose or for a machineries,
Yeah.
not for a running day-to-day operations most of the time. So this running day-to-day operations, or if there's any new order, to fulfill the order, they have to have a prepared readiness for taking other lines of funds also. If they
Yeah.
don't do these things, then round two will necessarily become delayed and the entire projection will go in for a toss.
Absolutely. And that is, I think that's really important for founders to understand. In the anticipation, it might actually kill your startup to just wait.
Yeah.
So that makes a lot of sense. And when you talked about other financial instruments, and a lot of founders ask, what are these instruments and what interest do they get these loans at? Specifically, you mentioned NBFCs and all. If you can help with more of that information.
See, there are so many startup specific bank branches are available by all nationalized banks. So it is for us to understand because when you go into a specialized startup branches,
Hmm.
they are not very specific about the collaterals. The major question what will come from Yeah, startup is that like when I go to a bank, they will ask for a collaterals. I don't have a collaterals. But the startup specific branches understand these limitations and they are ready to do the structured financing or they call it as a non-fund based financing by means of an guarantees, LCs for procurement of materials and those bill discounting and those kinds of facilities. Now, there are NBFCs which are ready to fully focus on startups on a short duration, on a case-to-case
Mm.
basis, for an order executions for a 3 months to 6 months. There are pure venture debt funds available, so-called kind of an startup investments, but on a debts and on a CCPS kind of an angle also, with stake, without stake. There are
Yeah.
aggregation platforms like Recur.club and those so many people who also supports not into an investments or as an investor, but who support the operations as long as they see some numbers coming in. So there are so many methods, avenues available. The one thing is it is that mind programming. We should be in a position to look it outside the scenario also rather than get ourselves fixated to this element of just talking to investors for an equity funding. Though that will also support them in one another angle is the if they are also able to look into other methods of funding, debt
Mhm.
funding or
Yeah.
short-term funding, which will also protect their equity. Understand the scenario. If there is a greedy investor and if
Yeah.
somebody is at a dire scenario of raising a bridge funding, he would have to give a higher stake than the regular fund round
Yeah.
because he will unless until he don't get the money that particular short money in that particular time, he won't be able to go to a next round. That he would have gotten soft commitment for next round, but with a clear condition that at this particular turnover, at this particular number, or this particular customer base, or this particular territory, I will not fund. So you will have to go in for an yeah higher stake dilution for a
Yeah.
bridge round than he would have committed for that. And he would be doing a lot other things how to cover it up. No, all these things are based. He should always look in for other methods of funding also.
Absolutely. And I hope this opens the mindset of founders that investment and raising funds only through investors is the only option for them. But there are a lot of other options that they need to explore, need to know about, and get more education on. That was really helpful. So if you and this question comes from founders who wants to know what investors are looking in the pitch deck. So if you have just 20 seconds and you have a deck and you are entering into a meeting with this founder, what's the first thing that you would see?
So 100% I will not look into a Samsung tab and all. Okay. I just see that because nowadays I see a lot of people giving in like you always see a same set of 10 slides. You know, it's this is like I'll only see the product, my understanding about a product, what differences he has brought in that thing,
Hmm.
what's the tech
Yeah,
element into it, whether it is duplicatable or not, is there any kind of an entry level protection, and whether it's a
yeah.
scalable, and whether the
Hmm.
numbers what he's talking is making sense, and his
Hmm.
valuation and ask is correct or not. So you just for this, as you rightly said, it doesn't take more than 30 seconds to a minute to just have an first hand impression about a startup.
Yeah, absolutely. So they need not spend a lot of time on putting so
You,
many and
you
half
call
of
it
the
as an
world in the
elevator
tab.
pitch or something like, but that's the truth.
Got it, got it. That was really insightful. And thank you so much for your time. Any final thoughts that you would like to share with all the founder community who's watching?
Uh, see, like only like if you look into a national goal of providing a larger space of employment and a larger internal growth and also huge export potential, we
Yeah.
strongly believe that startup ecosystem or startups will be the one who will be taking it further. So with that, our sincere appreciation and like a lot of love to all the startup founders. who really wanted to try everything, take risks, and also wanted to prove a point. We'll be there to support them in whichever way is there. Investment alone is not a support. Most of the
Yeah.
time, the founding for a founder, it is a vacuum at the top. He won't be in a position to even talk to his family, discuss about his idea, not talk to other people. So
Yeah.
we also wanted to address those areas also beyond investment. So we will be happy to support, be available, whichever way it is possible within our limitations. Thank you for this opportunity.
Thank you so much. Thank you so much, Devanand, for your time. And it has been an absolute pleasure to pick your brains on what founders are looking for answers so that they can grow, they can build better, they can raise better.
Yeah. Thank you, ma'am. Thanks. Thanks for your time.